Good afternoon and welcome this afternoon to Trading Index Options, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab. I'm joined out there in the chat by my good friend Connie Hill, 20 plus year veteran of the financial markets. And we were just having a conversation. I was just having a conversation with our producers about relative time frames because they were talking about a movie being old. And I remember when the movie came out, and it doesn't seem like that long ago, but it was 30 years ago. And I guess 30 years is a long time, but when we talk about options, things like index options, we talk about time frames of 30 days or a week or 14 days. That doesn't seem like a really long time, but neither does 30 years. So it's all relative. Hey, we're going to talk a little bit about those time frames today. We're going to talk a little bit about a couple of different strategies you might employ using index options, and we're going to jump into that here really quickly. But a couple of quick reminders and housekeeping items that we need to take care of. Remember that everything we talk about simply for illustrative and educational purposes only. It is not any kind of a recommendation or endorsement of a particular security or strategy. Remember that every symbol that we look at, simply for illustrative and educational purposes only. If you're going to trade options, make sure that you are aware of the characteristics and risks of standardized options. Remember that options carry a high level of risk. They are not suitable for all investors. When we trade index options, remember that the majority of the index options that we're going to talk about are European style options. That means that they cannot be exercised prior to expiration, which conversely means that they can't, that if you're short those options, you don't have the risk of early assignment. But just remember that American style options, which provide the opportunity to exercise an option right throughout the lifespan of the option up to and including expiration, those can result, if you are short those options, in early assignment. So just be aware of that. Now, paper money doesn't allow for that, but a live trading account does. We'll talk about some of those differences in just a minute. Remember also that technical analysis, probability analysis, fundamental analysis, all of those methods of analyzing the market are theoretical in nature. They're not a guarantee of what's going to happen in the future. Schwab doesn't recommend the use of technical analysis as a sole means of investment research. We're going to use the Thinkorswim desktop software platform. It is, again, a great learning environment, not a guarantee of future success. And as I said, it doesn't do certain things that a live trading environment might do. So just be aware of that as you move your practice from paper trading to live trading, that there are going to be theoretically some differences. One of the biggest differences that comes up is in order fill prices beyond early assignment of short options, those types of things. The paper money platform fills based on an algorithm, oftentimes at the midpoint between the bid and the ask. A live trading account is going to, those orders are going to fill based on actual market conditions and liquidity. So that might be vastly different than what you're used to if all you're doing is trading in paper money. So be aware of that as you practice, as you move again, your paper trading to live trading, and note some of those differences that occur. So let's pop over here to the Thinkorswim desktop software platform, see what's going on. Let's take a look at the SPX today. Big up day today. Gap up rally today. Big upward movement in continuation. I taught a webcast a little bit earlier today, Rachel Dashiell's Trading Price Patterns webcast I filled in for today. And we talked a little bit about this movement in the S&P 500, the fact that we've got maybe this kind of risk-on perspective, that there's some upward movement going on in the index. I also, on this particular grid, have the 50 and the 200 period moving averages there displayed. You can see that those have been parallel to one another for the last few weeks. They now do start to seem like they are diverging from one another. The 50 period moving average accelerating up and away from the 200 period moving average, never getting to that death cross, the 50 crossing below the 200. In fact, they didn't even kiss one another. They didn't even bounce off. They approached, went parallel, and now are moving in opposition here. So both moving higher, 50 moving a little bit faster than the 200. We take a look at the NASDAQ. Same kind of thing. Big gap up, big rally. We're at the tail end of the middle portion of earnings season. We see that the 50 and 200 got a little bit closer to one another, but you definitely see the directional difference here between the 50 and the 200 as this index moves up, up, and away. And I drew in that little bit of a bull flag pattern that's going on there in the NASDAQ. Take a look at the Russell 2000. 50 and 200 are roughly parallel with one another. This is maybe a more well-defined bull flag type of pattern. Once again, a gap up and a rally today. Now, that begs the question, with this gap up and a rally and a continuation, is risk done? Is risk over? I don't know. That's a good question. Let's take a look at our VIX grid to kind of get a sense of where we are with what's going on in terms of volatility. So I'm looking at the VIX grid, and I'm going to zoom in over here on the right-hand side so we can see this a little more closely. This is the VIX relative to the VVIX, the volatility of VIX. I want to look at the VIX by itself here in just a second, just for a moment. Here's the VIX by itself. And this is a one-year daily chart of the VIX. I've got here the 30-period moving average of the VIX. You can see that the 30-period moving average of VIX is moving in a downward direction. You can see that volatility today, which is interesting, despite the fact that we have a significant percentage increase in the broad market today. We have the SPX up significantly, which is what drives the VIX. We have the NASDAQ up, we have the Russell 2000 up. Big gap up rallies. And yet, volatility, which did bleed off down into the 16 handle, mid 16s, is now coming back up. And in fact, if we look at where it is, just a little bit higher than where it opened today. Now, net movement, yeah, it's still got a gap down, but positive movement on the candle itself, not necessarily positive movement yesterday to today. But the VIX not bleeding off as significantly. Now, that might be something that maybe we want to pay attention to. Big up day, usually we see the VIX down. And that's traditionally what has gone on. There's traditionally that oppositional correlation between the two. But the fact that we have the VIX stable and the market moving higher might give us some insight. Now, Lakshmi asks a great question. We have this VIX candle, and the VIX candle giving us this hammer type candle, right? It might be related, Chris, to breadth concerns, perhaps. Might be the distrust of this upward moving market. Climbing the wall of worry might be another way to describe that. But here's another thing to think about. So Lakshmi asks a question. Again, with this VIX chart, what does this mean on a hammer on the VIX, a support level? So the thing to think about is that the VIX, because this index, the VIX index, which is what this is not in and of itself a tradable instrument. So therefore, these candlestick movements that we see are not necessarily related to that idea of levels of support and resistance. If we were to talk about, for instance, the VIX futures, which I talk about in my futures trading webcast on Tuesday mornings, then maybe there's a little bit more of that level of support resistance idea. But that's also going to be related to what's going on with the VIX. So the VIX doesn't operate necessarily in terms of that same kind of technical analysis perspective that we might look at in terms of support and resistance of an equity, where there's buying pressure at a support level and there's selling pressure at a resistance level. But we can gain some insight from this. The fact that the VIX is moving, saw a push to the downside and then came back a little bit. Meaning that prices, implied volatility for options, specifically SPX options, went down, but is starting to bleed back up. That means that it got cheap enough that institutions primarily not retail investors, but largely institutions are buying, to Rita's point, buying put options or buying options in general, or speculating by buying long call options on directional price movement. So speculating against the market pulling back, hedging against the market moving back, or speculating that the market's going to continue to move higher. Both of those probably are occurring simultaneously. That's what gets us to this view of the VIX right here. So if you want to think about this, this is VVIX. VVIX is the volatility index of the VIX itself. The volatility index of the VIX itself, the VVIX, is a measure of how volatile the VIX is in terms of its movement. Or another way to think about it is how cheap is the VIX relative to itself? And is there a likelihood that investors, institutions, are likely to buy protection because it's inexpensive? So when the VVIX is lower than the VIX, there's an incentive for institutions to buy protection because it's cheap. They don't always do that. They oftentimes panic and buy when protection is really expensive. But by and large, institutions will do a bit of buying when implied volatility is low, when the VIX is low. And so we saw that recently. In the last couple of weeks, we saw the VVIX drop below the VIX. In fact, the VVIX right now is just at or below the VIX. So volatility is cheap, and volatility is cheap. Now, if we take this, and this is something that I've added, we talk about this on a fairly regular basis. Something I've added to this grid is just this price ratio. So I'm taking the VVIX and turning it into a ratio relative to the VIX. So when that ratio is high, meaning when the VVIX is well above the VIX, that's an indication that volatility is expensive. When volatility is low, when the VVIX is well below the VIX, that's an indication that volatility is cheap. Now, what this also does is this is going to lag a little bit to a certain extent. But I turned it into a price ratio, and I kind of came to an area and did a little bit of digging that if we were to think about what that price ratio means, that when this price ratio of the VIX and the VVIX is at or below that 4 level, that's generally an indication of when kind of the panic is over and there's maybe some complacency. That's post-panic. You start to see that VVIX getting back down into that area. When it's in this range between 4 and 6, that's kind of the general area where it lives. But when it's towards that high side, when it's at 6 or above, that's an indication that volatility is becoming a little bit more expensive. And perhaps that's an area where institutions are starting to perhaps panic a little bit, being willing to buy protection in the event of a possible adverse market movement. We're not there yet. We're at the 5.42 level. We're not even approaching 6. You start to think back here into December, and that's where the this VVIX-VIX price ratio was kind of sitting well above that 6 level. And that was a point at which the market, I've put the S&P 500 up here, there was an expectation that the market was going to start to turn. So institutions, and that was a long process. It was like a 2 or 3 month process where institutions were buying protection, and they weren't really necessarily panicking about it, but they were willing to pay up whatever prices were available to buy that protection in the anticipation of the market moving down. We're not at that level yet. So the market's not panicking. So that would suggest, just from that inference, that if the market's not panicking, they're not terribly, terribly, terribly worried about the fact that the VIX or that the S&P 500 is making a big move to the upside today, which is why we're seeing volatility kind of sitting where it is. But look at the trend direction here. That trend direction of this price ratio is definitely higher. That would suggest that it's becoming a little bit more expensive. So in anticipation of a possible pullback, and I think that's where we kind of get to the idea of the market getting toppy or frothy. You might think about it from that standpoint. We're not quite there yet. We're not at an extreme, but the trend is headed that way. Is it going to stay that way? I don't know. All right. I'm going to do this real quick. Since I've saved this as a study set on this grid, I'm going to go ahead and share this grid with you. Again, remember, anytime we share anything, it is for illustrative and educational purposes only, and it is not Any kind of a guarantee, it's not guaranteed as far as time or accuracy or anything else. And so I'm going to put that out there in the chat. I will also put it in the description page for this webcast for those of you that are watching this in the recorded version. So we're going to send that out there. We could do the same thing. Zinc, you could do the same thing for the move index. As a matter of fact, I've got a VVIX move grid. So the move index is our blue line here. So this is VIX versus the move. That's the volatility of bonds. So bonds becoming a little bit more expensive, bonds becoming a little bit more volatile. We had an FOMC meeting. Typically when you see that reversal, when you see that the move is the volatility of bonds, let me just activate this and move it over here. I'm going to move the move. And I'm going to activate this one and I'm going to put it back over here. There's the VIX, there's the move index. Bonds are getting a lot more volatile. Equities, less so. So there might be concerns. When the move index is moving up, that may be a concern that there is likely to be perhaps a flow back into bond prices and out of equities. That might be a warning sign. But it isn't always. When we see the move moving above the VIX, it doesn't always mean that we're going to see, excuse me, a reversal. And VIX tends to move faster than the bond volatility. Okay. I like that, Mary. That's pretty good. All right, let's pop back over here and take a look at a couple of things that we've got going on. Let's go over to the monitor tab and take a look at a couple of things that we've going on. So one of the things that we've got going on right now is a couple of weeks ago, we put on this volatility trade on the VIX index itself. And we bought, I think we did that last week, right? We bought a long call vertical spread, debit spread on volatility, expecting that volatility, because it was relatively low, was likely to go up. And guess what? It didn't. It went the other direction. So this trade, which has 12 days to go until expiration, we bought for $1.51. Our expectation was that it was going to go higher. The most that it could trade at was $4. We're starting to see this backing off a little bit. Now, here's the thing. There's only 12 days to go. Could this go higher? Yes. But what are we fighting with this trade? Because it is a long call vertical spread. We're fighting time decay. And if implied volatility is staying where it is or going down, well, that's working against us too. It's just not doing what we'd expect it to do, which is fine. Sometimes that happens. So we're going to go ahead and we're going to take this trade off. And we had already put in a target order to get out of this trade when it had done the majority of the work it can do for us. It's not doing anything for us now. In fact, it's starting to go against us. We've lost about 40 cents on the trade. So I'm going to close this trade down. I'm going to come up here and I'm going to say create closing order. We're just going to sell it and salvage what we can get out of it. There's just not a lot of time left here. So I'm going to fire that order off and we're going to close this down and get out of this volatility trade. We may come back and revisit this if VIX starts to move higher and revisit that idea of this moving, trading a directional volatility strategy. But now we've closed that trade down. We've salvaged some of the capital that we put into the trade. We didn't let it go to max theoretical loss. And we didn't let it just sit there and kind of languish and continue to decay away. So that's okay. Sometimes we take a loss. And it's better to take a small loss than it is to take a large loss. I was just in Boston a couple of weeks ago teaching the technical analysis and options strategies workshop. And if any of you have ever been to Boston, you might have gone to the Isabella Stewart Gardner Museum. It's also famous for having one of the largest art heists in the United States that's been unsolved. Anyway, there's a quote from Isabella Stewart Gardner, who was, as I found out, an art trader and a horse trainer and gambler. And she has this great quote where she says, "Win as if you're used to it and lose as if you like it." And I thought that was perfect for the idea of trading, because it gets to the idea that we should be willing to take a trade off. We should be willing to take a trade off if that trade is losing, take it off quickly. Take that loss instead of hanging on to that and not wanting to take a loss. Lose as if you're used to it, or excuse me, use as if you like it. And we should be willing to take a trade and let a winning trade continue to run if it's working for us. Win as if you're used to it. So don't get so excited about a win that you take the trade off right away. So I thought that was kind of interesting. Chris points out, I still have an open order. You're right, I do. So we're going to come up here to our working orders, and there it is right there. That was our target order to get out of that trade. So what we're going to have to do is come up here and cancel that and get out of it. So we're now out of that VIX order in that particular trade. So we'll go back to our monitor tab. We'll close down our working orders. Now we're out of that trade completely. Now there's another trade that we had been looking at. I wanted to look at really quickly here, and that's this one on the Mag 10 index. So the Mag 10 index, let's bring this back over to our chart grid. And I'm going to put this in our trading index options grid right there. And we'll put this in our double-sided grid. I'm going to leave it right here for just a second. We'll go to our longer term, and we're going to put this in MGTN:CGI. This is the Mag 10 index, and it has been rocking and rolling as we've been getting into earnings season, right? It's been making that move to the upside. So strong upward movement, strong directional movement. Let's look at the trade that we put on for the Mag 10 index, though. So we're going to go back here to the monitor tab, and we're going to take a look at the trade that we put on. So we had actually created a long put spread in this case, right? We were looking at this moving somewhat to the downside, right? Trading this counter trend. So we put on the trade, we bought the 420 put, and then we sold the 430 put. Actually, no, I'm sorry. This is a short put spread, short put vertical spread. Our expectation was this was going to move to the upside. So what has this done? Well, let's take a look at what the trade has done so far. So we bought the 420. We bought that for $4.05 minus, actually, yeah, paid $4.05, and we brought in $5.80. So let's do this. $5.80, what we paid for, or what we brought in, minus the 405, and the initial trade, we sold that initial trade for $1.75. What's it trading at now? Let's take a look. So if we were going to buy this one back, we'd have to pay 16 cents minus what we could sell this one back, which is 11 cents. It's trading for a nickel. It's done. It's got 9 days to go until expiration. It's done everything that it can do for us. It has no more left to give, this short vertical spread. But we've got 9 days left. Let's hang out and get that additional nickel. Huh. Could the market turn around? Yes. So here's where I say, and some of you have heard me say this on stage, buy it back for a nickel and avoid the pickle. We've got every bit of risk in this trade. Every bit of risk that we put on when we put on this trade that still exists. Are we going to keep that risk in this particular case for the sake of an additional 5 cents? And Ricebird says, no, because you have to ask yourself the question, would we put on the same trade right now? Would I put on a 434.20 short put vertical spread for a nickel right now for 9 days? And the answer is that very, very likely, of course not, right? So we're going to take this trade off and we're going to look at something else. So Eric asks the question, what about liquidity? How liquid is MGTN, Mag 10? Well, let's see. Let's see how hard it is for us to exit this trade. So what I'm going to do is I'm going to come up here and I'm going to do a create closing order. And we're going to buy back that vertical for a nickel. And we'll see if we can get it. Midpoint's 2 cents. I'm going to give it a little bit just so that I can get out of the trade. I'm going to give it up to that 4 cent midpoint, and it's moving a little bit on us. Click on confirm and send, read through that order, make sure I know what I'm doing. I'm closing that trade down, clicking on send, and we're going to close it down, and I filled it. Filled it for a penny. Now, obviously, this is paper money, so it's probably going to feel a little bit better. But if we take a look at um, what the liquidity is of these options, right? We start to look at what the liquidity is of these options. Let's put this back on single, and let's put this on volume and open interest. And they're starting to become a little bit more volume and open interest. So as long as a trader is not getting crazy about the number of contracts that they're trading, there is some volume there. There is a little bit of open interest. It is not overall across the board, but something to think about in terms of a position, and gives access to or exposure to those Mag 10 stocks. So what I'm going to do is I'm going to come over here. Looks like we've got a couple of orders there in place. So we're going to come back to our monitor tab, go to our working orders, and where are those working orders? In this particular case, we don't have any. Those are on the, let's see. Oh, do we have other positions? I don't think we do. Maybe I do. Maybe I put a different one on. All right, so let's take a look now that we've closed those two down. Wait a second. Wait a second. Something's happened here. Something's different. All right, you know what I'm going to do? I'm going to do this. I know what I did. Anybody notice what I did? I don't know if anybody noticed what I did when I did that trade. And here's, again, testament to the idea of reading the freaking order before you place the order. You notice what happens when you've got a position on and you do this position dissector, and this is something new. And I don't know if any of you have ever fallen into this particular positional mistake, but there's this one right here. No, Ricebird, here's what's happened. Here's what happened. When I was going to close that trade down, I slid my mouse up just a little bit, and instead of creating a closing order, I added to the position by creating a new one. Okay, so now what do we do? Well, all right, fair enough. That's what can happen, right? So, no harm, no foul. Let's create some closing orders. Let's go ahead and close this stuff down. Let's go ahead and close down that vertical spread. And let's try to take, yeah, see? All right, good learning tool. I'm going to go ahead and close this one down and make sure it says to close. Click on send. We're going to close that one down. Now we're out of one. Now we can go back to our monitor tab, see what we've got left. Now we've got our original vertical, which we were trying to get out of to begin with. Holy cow, right click, create closing order. We're going to buy that diagonal spread back and eliminate that trade. Wait a second, something weird is going on. I'm going to do this a leg at a time, guys. Let's do this a leg at a time. All else fails, take it off, peel it off one leg at a time. But when you do that, when you peel it off one leg at a time, always good idea to think about closing the short leg first so you're not left with a naked obligation. So I'm going to create that closing order for this one. We're going to buy that one back and close it down and click on confirm. And no, delete. Why is that giving me a new opening order? Let's close this one down. Create a closing order. Buy it back. That's the right one. 15 May. Buying it back for 26 cents. Let's close that down and buy it back. Let's click on confirm and send. Read the order. Send it off. And did that close it down? Let's see. Let's see if that eliminated that position. Go back to our monitor tab. It did not. It created another one. Something's going on. I'm going to have to figure that one out, guys. All right. Now, I'm going to work through that. We'll figure out what's going on there and why it's creating that order. Create closing order. Sell that one back the 11 May. Okay, now it's out of that one. Let's just go through and let's do this one at a time. Now we're short this one. I don't want to be short this one. I want to right click and create a closing order to buy it back. Buying back the 15 May because I'm short that one, right? Create closing order, buying it back to open. It's opening another one. 11 May. That's weird. Edit the order. 15 May. That's 15 May. Why is it not changing? All right, I'm going to figure that one out, guys. Yeah, good question. Okay, cool. Sometimes things don't behave as they should. We'll find out. All right, now let's go back to the SPX. Now let's come back to our SPX grid and see what's going on with the SPX. So we're going to go back to our monitor tab. Thanks, guys, for letting me kind of work through some of those challenges. Change from auto to close. Yeah. Oh, maybe so. Okay, I'm going to come back to that because I've got something else I want to do. Here is our index option that we do on a weekly basis. Selling at 14 days, buying it back at 7. We sold this last one for $2.20. It's now trading for 12 cents, 12.5 cents. It's done all the work that it can do. It has done every bit of the work that it can do for us. And we can buy it back for 15 cents. So we're going to right click, create a closing order. Let's see if this works. And we're going to create that order to close this down and confirm and send. Make sure that's what we want to do. To close, click on send, buy it back. It's done everything that it can do for us. Okay. I'm going to figure that one out, guys. So I promise you next week we're going to talk more about that and figure that order out, and I'll see what's going on. So here we are on the S&P 500. Our directional trade is this. If the SPX is above the 200 period moving average, then we sell a put spread. If it's below the 200 period moving average, we sell a call spread. It is well above the 200 period moving average, right? Yeah, you could, Dagan. You could build a ladder trade. You could ladder those over different days, but you've got to remember that if the market moves, you get a lot of exposure potentially. So keep that in mind. Keep your overall position size in mind. But this is well above the 200. We're going to sell a put spread here. We know that momentum is moving to the upside. So I'm going to do two things. I'm going to come over here to the right-hand side. This is our time hack. So I just want to double check, when is our 14 days to go until expiration? That is the 20th of May. I wonder if that's why. I wonder if it was defaulting to the AM. Okay, anyway, aside. All right, we're going to go out to the 20 May expiration here. So the first thing we're going to do is we're going to take our time hack. We're going to right click and activate it. We're going to take it out to the 20th of May. Okay, we're going to put it right there. And then we're going to say, where is that dot at that intersection? It's at 7108, which I'm going to round to 7110 because I'm pretty sure I'm not going to have it a 7108 strike, but I'm pretty sure I'm going to have a 7110. And you notice as volatility has gone down, what's happened to the width of this probability expiring cone? It has narrowed itself down. Okay, so as this has started to narrow, that range has decreased. We're probably going to get a little bit less premium. We'll see. So now what we're going to do is we're going to go out to the trade tab. And we're going to look out here at the 20 May expiration. I've got 150 strikes displayed. I want to go to the, where were we? 7110 strike price. The 7110, notice I don't even have to have 150 strikes out here. I could probably go 100 strikes to get to the 7110. All right, there's the 7110. Let's put this on Delta, Theta, and Vega. 7110, about the 14-cent delta. So it started to increase a little bit, but look at the premium's gone down since last week. So 7110 we're going to sell, and we're going to buy the 7090. So still keeping this 20 points wide. Last week we got $2.20. Volatility's decreased. Now we're getting $1.75. So not as much premium, but we're further out in terms of probability, in terms of delta. So lower probability of it getting hit, higher probability of success, lower premium is always going to be the trade-off. We're going to click on confirm and send, read through this order. $170 against 1,830, but higher probability that we're going to get a winning trade here. Not a guarantee by any means, higher probability of that success. And I'm going to go ahead and we're going to put this in our index options weekly group. And I'm going to fire that order off and sell it. We sold it for $1.70. Now that's out there and that's doing what we wanted it to do. Now, there's nothing magic about doing this on Wednesdays. The only reason we do it on Wednesdays is because that's the day that we teach the webcast. You could do it on a Monday, a Tuesday, a Thursday, a Wednesday, a Friday. It doesn't matter. Now, we talked a little bit about that last week and the fact that Mondays may be a little more volatile. Friday's a little bit more volatile. Tuesday oftentimes sees counter trend moves, or at least counter to Monday. So Wednesday makes some logical sense though too, but there's nothing magical about Wednesdays from that standpoint. All right, so now we put that trade on and that is working in the direction that we want it to go. So we're going to go back over here to the chart. Our expectation is that price is going to continue to move to the upside, and if it does not, notice what's happened to implied volatility. Implied volatility has collapsed. Time decay is going to work in our favor, and the reason we're doing 14 days to go until expiration and buying it back at 7 is we're capturing that time decay in the beginning of this trade. Because this is so far out of the money, these options behave a little bit differently than an at the money option in terms of time decay. Time decay tends to occur most rapidly at the beginning of the trade, less so as we get closer to expiration in a far out of the money option. So that's one of the things that we have to pay attention to as we put this type of trade together. I'm going to spend a little bit, rather than put a different trade on, I want to pop back over because I told you this 2 or 3 times that I was going to talk through this idea. I'm going to come back over here to the trade tab and I want to look at something here. So what I want to do is I want to filter this to our put options only. I'm going to filter our option chain to put options. And I'm going to filter our strike prices here. Let's see if we can filter this strike price. I'm going to keep this filter between we'll keep it kind of right at those out of the money options. So I'm going to go from about 70. I'm going to bring these strikes down from about 8,000 to about 7,500. So we're kind of seeing all of these kind of out of the money strikes. Maybe bringing that in just a little bit more. So we'll take this down to about 8,000. I'm just going to filter this option chain. We'll go 7,900. And I want to show you something here. Because we don't natively show charm in this discussion. We don't natively show charm in the Thinkorswim platform. Charm is a second order option Greek, but we don't show it natively on the platform. So we kind of have to make this assumption about it. So what I'm going to do is I'm going to show delta and theta. I'm going to change my layout to delta and theta. So we'll go customize our column set. We'll remove Vega from this list and look at OK. All right, so now notice something. The further out of the money you are, here we are 14 days to go until expiration. If we go further dated, let's say we go out to say an 11 June option. That's 36 days to go until expiration. We scroll down here and let's take a look at what that delta is. And let's take a common strike. Let's take the 7,200 strike here. You notice what your theta is. It's $1.66. Now, here's what we would expect to have happen. We would expect to have that $1.66 number increase as we get closer to expiration. So let's go to an option, the same strike. Let's go to an option that's, say, for instance, 7 days to go until expiration at the 7,200 strike. That's this one right here. Okay. So notice that theta number did increase, but notice what's happened to delta. Same strike price, but delta has decreased significantly. Let's go back out in time. Let's go to our the one that we were looking at, which was this one right here. Our delta went from 30 to 14. We lost about half of our deltas. That option is so far out of the money that as we get closer to expiration, there's just not a lot of directional sensitivity. Charm has eaten away at that delta. But what's happened is that our rate of time decay, especially as we get down and further out of the money, that rate of time decay begins to diminish. Now let's get down here to 1 or 2 days to go until expiration. Still at the 7,200 strike. And notice that our rate of time decay, while it's increased from further out in time, from 7 days to 2 days, that rate of time decay has slowed down. It's decreased. And if we go down to 1 day to go until expiration at the 7,200 strike, rather than, notice this is when it really starts to hit us, is in this last week to go until expiration. Now we're at 1 day to go until expiration. Our delta directional sensitivity is almost gone because of charm. The option Greek charm has essentially decayed away or destroyed all of those deltas. And our rate of time decay is about half or less what it was. Wait a second, though. The at the money strike, that time decay has gone up, which is exactly what we expected to do, right? That at the money strike, as price has gotten, as we've gotten closer to expiration, that rate of theta, that rate of time decay has increased exponentially. That's what we expect to have happen. That's that curve. But far out on the curve here, far out of the money at the 7,200 strike, time decay has gone down. The rate of time decay has gone down. That's why I talk about this from the reason that we put this particular trade together. Because the at the money strike does this. The at the money strike from a time decay standpoint does this. The out of the money strike, the one that we've been looking at, the out of the money strike time decay curve looks like this. We want to take advantage of rapid time decay. That's why we're selling at 14 days and buying back at 7. That's why we're doing it. Charm is the relationship, if you want to think about it, of the number of, not necessarily theta, Chris. Charm is the relationship of the number of days remaining to expiration to delta. Delta is going to fade away, especially out on the tails. Delta is going to fade away by the amount of the charm the closer we get to expiration. So delta doesn't remain constant as we get to expiration at the same strike, especially if it's out of the money. At the money strike, yes. Delta is going to stay relatively constant because it still represents kind of that 50-50 proposition. But you're far out of the money, far in the money, there's just not that much more directionality you can gain. It can only go to 1 or it can only go to 0 because delta at expiration is going to be 1 or 0. And you're not going to have any more time value. That's why charm is an important consideration. We don't show it, but it's something to have in the back of your mind that delta changes as we get close to expiration, and it's a function of the amount of time that's remaining, and it's also a function of where you are on the option chain in terms of being in the money or out of the money. Wow, that was a deep dive. Guys, thanks for letting me geek out a little bit here on some of this stuff, which is kind of fun. But I promise that I'm going to find out more information about that that error that we were having and the reason why it wasn't making that trade. But if you want to learn a little bit more, let me kill my annotation there so we don't see that. I'll close all those. Come on over here to the Trader Talks webcast page. I don't even know if we've talked about charm before in webcasts. CHARM. We might not have. Cameron might have in this one. Other than that, maybe it's just charming. Cameron is just charming. So some good stuff. All right. There you go. When you come out here to the Trader Talks webcast page, click on that subscribe button if you haven't done so already. My thanks to Connie Hill for helping out today. My thanks to all of you guys for being here and our great production staff. We will see you guys again next week. Take care, everybody. Bye-bye.